Hey, this is Josh Alexander with Orange County Housing Market News. If you're a returning subscriber, thank you so much for your continued support. I really appreciate it. If this is the first time you've listened to this show is all about Orange County real estate. So I go over different trends happening in the market, I interview local experts, and then if you're a buyer or seller, I go over different timely tips that you need to know about what's happening in the market now that affects you. So if you're looking to buy or sell a home in the near future, this is a great place to start. Now, with that being said, on today's episode, I'm going to be discussing one of the most brought up topics in the news right now as it relates to the housing market, and that is, are we currently in a housing bubble that is about to burst? So I'm going to go over the data, and I think the answers might surprise you. So let's go ahead and get into it. So real quick, before we go over everything, I do want to mention that whether you're listening to this through podcast or watching it via video, I am going to be providing a link in the show notes that's going to go over all this information plus more in a blog post that I wrote. So that way, if you do want to get some more information, check out the graphs, look at even more detailed analysis of what I'm talking about here, feel free to check that out after the show. Okay, so with that being said, let's go ahead and look at appreciation first. So last year was a crazy year for real estate. Overall, the United States, on average, you saw about a 10% appreciation in the housing market. And when you compare that to the long-term average, which is right around the 3.8% every year, you can see why a lot of people are growing concerned about, are we in a bubble? What is going to happen? This type of appreciation is not sustainable. When is the market going to crash? So before we get too crazy and start looking at that, let's go ahead and zoom out a little bit and look at some of the long-term averages over the last 20 years of what appreciation has done. So I'm going to pull up this graph right here so you can kind of check it out. Now you'll be able to see what that long-term average, again, about 3.8% appreciation should be per year and what we've actually done. And the first two things you want to look at is, one, prior to last year, the previous 11 years before that, we were actually underperforming on appreciation in the United States as we were continuing to recover from the Great Recession. And then the second thing I want to point out is that before we had the last housing crash, you can see it took many years of higher than average appreciation before we got to the point where the housing bubble popped and everything crashed. And everybody knows the history and what happened there. So those are the two things I want to point out, because if we look at this market as a whole, you can kind of see that when that crash happened versus the recovery that we've had, those kind of balance each other out. So yes, last year we did see a much higher average appreciation than usual, but there's a lot of reasons why I don't think we're going to see that type of appreciation this year as well as the years going forward. So let's go ahead and break some more data down and get even deeper into why I don't think that's going to happen. So let's look at the supply side first. So if you remember from my last episode, I pointed out that we started this year off with the lowest inventory since at least 1981, because that's when they started keeping records of these things. So it was probably even before that. So needless to say, we have extremely low inventory right now. And if you're a buyer right now trying to find a home, you know that you're probably very frustrated because there's just not enough homes hitting the market. And every time one hits the market, there's 10 offers on it. It's very hard to get into a home right now. So there is some good news on the horizon for buyers, because I do think that some of this inventory will start hitting the market, and there's three main reasons why. So let's go over those. So the first one is that we are about to enter the spring market. Traditionally, every single year at the end of February, early March is when you start seeing homeowners put their house on the market in larger and larger numbers. And that number keeps increasing all the way through at least May. This year, I have a feeling it's probably going to be a little bit farther, so probably into June, but you should expect inventory to rise just because the traditional cycle is going to start where that spring market comes. People want to get their house on the market so they can get it in escrow and then hopefully close escrow towards the summertime. So if they have kids, they're not having to uproot everything and move in the middle of a school session. So that way they're moving during the summer. So that's one of the reasons why you start seeing a lot of these homeowners place their house on the market in these next couple months. So keep that in mind. Now, the second reason why I think inventory is going to start increasing and helping out buyers a little bit is that we have a lot of pent up people from last year that wanted to sell their house, but just didn't feel comfortable, whether it was for safety reasons or they didn't know what the economy was doing. They didn't want to put their house on the market. They wanted to stay put. This year, they're now at a point that are saying, okay, I waited, the vaccines are starting to roll out, the economy's starting to improve, I can see the light at the end of the tunnel, I think I'm gonna go ahead and get my house listed now. So on top of the normal inventory that we typically see during the spring market cycle, I am anticipating more inventory than usual because of that pent-up inventory from last year that never hit the market. And then the third reason, and you might be reading a lot of this in the news again, is foreclosures. However, I do want to put a big asterisk by these foreclosures because there's not going to be a giant wave of foreclosures like some of these articles you might have been seeing in the news. And there's a lot of reasons why. So let's go over a few of those. Again, the article that I wrote will break down in more detail, but let's go over a few of them just so you can get a general understanding of why I don't think you're going to see a giant wave of foreclosures hit the market all at once and create some kind of flood of inventory that's going to pop it into a buyer's market overnight. So the first reason is that right now, a lot of people in forbearance, they continue to get extensions. So it was just announced that anybody that has a Fannie Mae or Freddie Mac loan can go all the way to August of this year now in forbearance without having to start the foreclosure process. The different lenders have different standards. So some of them are extending them until June, some of them to August. So as these people come out of forbearance in different periods, they're going to start the foreclosures in different periods, which will lead them to eventually put their house on the market at different periods and not all at once. The second thing you need to understand is that out of the people that are currently in the forbearance programs right now, 90% of them have at least 10% equity in their house. So why is this important to know? Well, if you had 10% equity in your house and you had the option of selling your house and either at least breaking even or making a profit or going through the whole foreclosure process with your bank, which option do you think most people are going to choose? Most people are going to say, okay, I'm not going to be able to pay for my house. Let me go ahead and sell it. The market is great right now. They're going to get top dollar for their house, put it on the market, and either walk away with a profit or at least break even so they don't have to go through the foreclosure process. The other important thing to remember is that the people that have exited forbearance so far, a majority of them, 85% of them, have basically exited with either they paid off their loan in full or already sold their home, they're caught up on their payments now, or they've worked out some kind of loan refinance with the bank so that way they can keep their house. There's only about 15% of people that have been coming out of forbearance that are in any kind of trouble and might have issues in the future. So those are some key factors you have to remember. Not everybody in forbearance is going to have to go through the foreclosure process. The last thing I do want to mention about the whole foreclosure process is it doesn't happen immediately. The foreclosure process could take months, even up to a year. So any of these foreclosures that we are going to see, they will start trickling onto the market because there were people that were in foreclosure before they put a ban on that when everything happened with the lockdown, that will start going out of that process and start going through the foreclosure process as soon as the summer. But the majority of them won't start hitting the market till the end of the year, going into 2022. And again, they're going to be spread out and they're also going to be a lot less than a lot of people realize. Again, it's not everybody in forbearance that's going to be going through the foreclosure process. It's just going to be a small fraction of those that don't have the means to continue paying for the mortgage and can't work out some payment arrangement with the bank to be able to keep their house. So that being said, those are the three reasons why I do think supply is going to increase steadily over the next couple months, which is going to help out buyers. However, it's not going to put it into a balanced market or a buyer's market anytime soon. We are still going to be in a seller's market, and the main reason is because of the extremely low inventory on the market. when these homes do start hitting the market, they're quickly going to be absorbed by all the demand that's happening right now because there is still extremely high demand in the marketplace. So this is not something that is going to swing the market one way or another very significantly. However, it will help take us out of an unsustainable, extremely hot seller's market and put us back into a regular hot seller's market, and that way the appreciation will start slowing down. So now let's look at the demand side of things and how that's going to be shaping up over the next couple months as well as the rest of the year, and how that's going to help the housing market get back into more of a healthy appreciation cycle so we don't get this overheated market year after year. So one of the biggest reasons, and I've said this time and time again, that we have such high demand right now is because of the extremely low interest rates. However, they are finally back on the rise again. So at the beginning of the year, they averaged around 2.67%. Just this week, they're almost at 3% already. So they have gone up pretty significantly. Right now, they're hovering around 2.97%, which is the highest we've seen in a while. So it's something to keep an eye on because as interest rates go up, you start seeing some of the buyers that were just on the edge of being able to afford homes start to drop out of the market. And we're starting to see that impact by looking at mortgage applications. So mortgage applications kind of give you a good idea of what the demand's going to be in the next 30 to 60 days. Those are people that are looking to take out a mortgage, getting approved for a mortgage loan so they can go shopping for a house. Mortgage applications are at no means low right now, but they are starting to decline a little bit over the last couple of weeks as we've seen interest rates go up. So that's a good indication that the demand will start to go down a little bit over the next couple months. So how high will interest rates go by the end of the year? Well, most experts are predicting that they're probably going to be hovering right around 3.1 to 3.5% by the end of the year. So right now they've already bumped up to 3, so they probably won't go too much higher by the end of the year. We should start seeing those increases in interest rates slow down a little bit. However, they are still projected to continue to climb slowly through the back half of the year. So it is something to keep an eye on as a buyer because the higher they go, the less home you can afford or the higher your monthly mortgage payment's going to be. So why are these interest rates going up? Well, one big key indicator on what the interest rates are doing is looking at the 10-year Treasury bond, because this is something that tracks very well with the 30-year fixed mortgage. So if you look at the history of the 10-year Treasury bond as well as the 30-year fixed mortgage, they pretty much go up and down together throughout the history of the last 50 years. However, during the pandemic, we did see them split a little bit more than average. So on average, you usually see a difference of about 1.5 to 2% between the 10-year Treasury and the 30-year fixed mortgage. So for instance, if the 10-year Treasury is at 1%, you would expect mortgage rates to be hovering around 2.5 to 3%. However, over the pandemic, so the summer months going into the fall, we saw averages go as large as 2.7% in terms of the spread between the two, but they've been gradually coming closer and closer back to that 1.5 to 2% mark, and now we're basically within that margin. So I do expect that the 10-year Treasury will start to give you a much better indication on a day-to-day basis of what the interest rates are going to be doing moving forward, because they're now back in line to where they should be. And so you should be able to use that 10-year Treasury as a more predictable indicator of what the 30-year fixed mortgage is doing. So one last note on the demand side of things in regards to the interest rate. Even if we do go up to that 3.5% interest rate, we're still looking at some of the lowest rates we've ever seen in the housing market. So even though that might seem a little bit high compared to what we've been used to over the last couple months, 3.5% is still an excellent rate for a mortgage. So it is going to be able to keep that demand chugging along. You're not going to see a giant dip in demand just because interest rates go up to that 3 to 3.5% amount. It will decline a little bit, but not significantly enough to really impact the market again to bring us out of a seller's market anytime soon. From what we've seen in the past, interest rates would really have to get up to above 4% before you start seeing a significant decrease in the demand side of things. So if that happens, yes, we could have demand go down significantly. But again, because inventory is so low and because there is so many people looking for homes, and even at 4%, there's a lot of people looking for homes, that you're not going to see that transition from a seller's market to a buyer's market where all of a sudden homes start losing appreciation. what we're going to see happening most likely is that appreciation is going to slow down. So instead of 10%, the average that most people are predicting at this point is somewhere around 5%. So half of the appreciation that we saw last year, which is still a little bit above the average of the 3.8% I talked about at the beginning, but it's much more in line with the traditional average, and it will help the housing market cool down a little bit and avoid us getting into too much of a bubble where we're seeing 10% or more appreciation for year after year, causing us to get to a point where some kind of major correction would have to happen. So yes, we had 10% last year, but we are expecting about half of that this year, and then maybe even a little bit less the next year after that. However, appreciation is still predicted to continue over the next year or two based on the current economic data that's out there right now. So buyers, there is a little bit of good news on the horizon. It's not great news, but demand seems to be going down a little bit, possibly in the next couple months, and supply should start increasing a little bit more significantly in the next couple months as well. So the chances of you getting into a home will be a little bit better. However, you do have to continue to remember that every day you wait to get into escrow at this point, home prices are still appreciating. There's still multiple offers on every house that are hitting the market right now that's placed on fair market value, especially under the $1 million price point. So the longer you wait to get into escrow, the higher home prices are eventually going to be when you go through and actually purchase your property. And the other thing to remember is that interest rates have been continuing to rise since the beginning of the year. So if you're going to wait another month or two, although I don't expect them to continue to climb as quickly as they have been, there is good chance they will continue to climb a little bit over the next couple of weeks. Again, further pricing you out of some of those properties you might be able to afford now. Now, on the other hand, sellers, I really don't know how to tell you this any more than I already have pretty much every single episode, but get your house on the market now. You're going to start seeing more competition into the market as we get into the spring season, which is only a few weeks away at this point. So right now, it's crucial for you if you want to sell your home and get it on the market peak demand, you want to get your house on the market as soon as you can, because as we get farther down the year, you're going to have more and more competition from those people that are placing their home on the market because of the standard spring market, because of the pent-up inventory from last year, as well as during the summer, you'll start seeing a few of those foreclosures start hitting the market as well. So the longer you wait, the more competition you're going to have. So get your house on the market now. Other than that, that's pretty much all I have for you today. So I hope this kind of cleared up some of those fears you might have about, are we in a bubble? Is this bubble about to burst? There's really no evidence that we're in a current housing bubble right now. If we had 10% appreciation happening year after year after year, that would be a completely different story. But it's looking like last year was kind of an anomaly, just like a lot of things were last year. And this year we should slow down that appreciation. It looks like supply and demand will be closer to being a more healthy balance as we get further down the year and continue into 2022. And one last reminder, if you do want more information, more graphs, statistics, if you're that kind of data nerd like myself, please see the show notes because I will have the article posted in there so you can check that out as well to get more information on that. So until next time, stay healthy, stay happy, and I'll see you later. Bye.